Hello and welcome. Today, we're going to pull back the curtain on a really fascinating part of the Canadian tax system, refundable tax credits. Now, these are so much more than just a simple deduction on your tax form. They're actually a powerful tool for social and economic policy, but honestly, they're often misunderstood. So, let's dive right in. Just a note, this entire explainer is based on materials prepared by Dr. Samir Al-Rashani with some AI support, which gives us a really solid and accurate foundation for our discussion today. Okay. Let's start with a number that I think might actually surprise you. For the 2023 tax year, the Canada Revenue Agency reported that over 6.1 million Canadians filed what are called nil tax returns. That means returns showing little or no income, and they were filed for one main reason: to get money back from the government through these very credits. And that begs a pretty big question. How is that even possible, right? How can you get a refund on taxes you never actually paid in the first place? That's the central puzzle we're going to solve today. And the answer, as you'll see, lies in the very unique nature of refundable credits. So to solve that puzzle, here's our roadmap. First, we'll break down the two main types of tax credits. Then we'll look at some real-world examples of how they support everyday life, how they invest in people's skills, and even how they help us adapt our homes for our families. And finally, we'll hammer home the single most important step you need to take to access any of them.
All right, let's start with the most foundational concept. Understanding this one difference is absolutely key to everything else we're going to talk about.
So, here's the crucial point. Non-refundable credits, they can only reduce the income tax you owe down to zero. That's it. If your credits are worth more than your tax bill, that extra value is usually just gone. But refundable credits are a completely different animal. The Income Tax Act treats them as if you've overpaid your taxes. What this means is that if the credit is bigger than the tax you owe, even if you owe zero, the government actually sends you the difference as a refund. It's a direct payment right into your pocket.
Okay, so let's see how this actually plays out in the real world. We'll start with some credits that are designed to give direct financial support for essential, everyday costs.
First up, a familiar one, the GST/HST credit. Its whole purpose is to help offset the hit that sales tax takes on lower-income households. What's really interesting here is that you don't even have to apply for it or calculate it yourself. The CRA does all of that for you automatically, based on the info in your tax return. But here's the key takeaway, and it's a simple one. If you don't file a return, the CRA has no information. And if they have no information, you can't be assessed for eligibility. Bottom line, no file, no credit.
Next, let's talk about the Canada Workers' Benefit. The government's official goal for this credit is pretty clear. It's all about making work pay. But why is that even necessary? Well, it's actually designed to solve a very specific and tricky economic problem.
This problem is often called the poverty trap, and it can be a real challenge. You see, for someone receiving social assistance, taking a low-wage job can paradoxically make them financially worse off. The income they earn might actually be less than the benefits they lose, things like subsidized housing or prescription drug coverage. So the Canada Workers' Benefit tries to bridge that gap. It tops up earnings to make sure that going to work is always rewarded, not accidentally penalized.
Now, let's dig into another credit with a really detailed case study. This is the Refundable Medical Expense Supplement. It's for working folks who have high medical costs relative to their income. Let's meet Mr. Futon's family. We're looking at their situation for the 2025 tax year. We can see their individual incomes, their total medical expenses, and their combined family net income of $36,400. So the question is, how do we get from these numbers to a refundable credit?
The calculation is basically a three-step process. First, we calculate the base credit from their medical expenses, and that comes out to $1,018. But then, this amount gets reduced because their family income is over a certain threshold. That leads to a reduction of $155. Finally, we just subtract that reduction from the initial credit to find out what's left.
And there it is. That leaves Mr. Futon's family with a final refundable credit of $863. Now get this, his net federal tax payable was zero. But because this is a refundable credit, he still receives that full amount as a direct payment from the government. It's a perfect illustration of the concept we talked about at the beginning.
All right, let's shift gears now and turn to a different category of credits. These ones are designed not just for support, but as a real investment in people, in our human capital.
A fantastic example is the Eligible Educator School Supply Tax Credit. This one acknowledges a simple reality that many of us know is true. Teachers and early childhood educators very often spend their own money on supplies for their students. So this credit gives them a 25% refundable amount back on up to $1,000 of those expenses.
So what kind of supplies actually qualify?
Well, the list is pretty long, and it's broken into two main categories. First, you've got your durable goods. This includes all the modern teaching tools you'd expect, like laptops and tablets, webcams for remote learning, all sorts of educational software, and even things like games, puzzles, and electronic toys that really enhance the learning environment.
And the second category covers the consumable goods. You know, the everyday stuff that gets used up in a classroom pretty quickly. Think construction paper, art supplies like glue and paint, materials for science experiments, and of course, all the basic stationery. The only catch is that the employer has to certify that these supplies were bought specifically for teaching.
Another really important investment tool is the Canada Training Credit. This one is aimed right at working Canadians between the ages of 26 and 65 to help them upgrade their skills. And it's not a one-time grant. It actually accumulates over time. It's kind of like a savings account. Eligible individuals build up a balance of $250 each year, and for 2025, the maximum they can claim is $1,500.
Let's make this real with Michael's case. Let's say he paid $4,000 in tuition, and he's accumulated that maximum training limit of $1,500. The credit is calculated as the lesser of two amounts, either half his tuition, which is $2,000, or his accumulated limit, which is $1,500. So in this case, Michael gets a $1,500 fully refundable credit, which directly helps reduce the cost of his professional development.
Okay, our final category of credit is a really interesting one because it reflects how our society and our family structures are changing, specifically how we care for family members across different generations.
This is the Multigenerational Home Renovation Tax Credit. It's specifically designed to help families cover the cost of creating a secondary suite for a senior or for a family member with a disability. The requirements are pretty specific. It has to be a self-contained unit with its own entrance, kitchen, and bathroom. But the financial support is significant. It offers a refundable credit of up to $7,500. And here's a really unique detail. This benefit can only be claimed once in a lifetime for any specific qualifying individual. That makes it a truly one-of-a-kind form of support.
So, we've covered a lot of ground today. We've looked at different kinds of credits that serve all sorts of different purposes, but every single one of them shares one single non-negotiable requirement.
If you only remember one thing from our entire discussion today, please let it be this. You must file a tax return, even if you have zero income to report. Filing is the trigger. It is the mechanism that allows the CRA to see you, to assess your eligibility, and to deliver these benefits. Without filing a return, you are effectively invisible to the system.
And this brings us to one final big picture thought. We've seen how refundable credits deliver support for living costs, for professional development, and for family care. So as more and more social policy is channeled through the tax system, we really have to ask ourselves, is the simple act of filing an annual tax return becoming one of the most critical financial activities any Canadian can perform? It's certainly something to think about. Thank you for your attention.